Spot gold performance from Monday 13th of July to Friday 17th of July 2026. Dollar strength, Fed policy expectations, and HORMUZ tensions shape market movement by AZLAN, ADNAN, MA. Spot gold traded through a volatile but broadly range-bound week from Monday 13th of July to Friday 17th of July 2026, as investors balanced competing forces, geopolitical risks surrounding the Middle East, concerns over possible disruption in the Strait of Hormuz, movements in the U.S. dollar, Treasury yields, and expectations surrounding future Federal Reserve monetary policy. Unlike some previous geopolitical crises where gold immediately surged as a safe haven asset, the latest tensions around the Strait of Hormuz produced a more complex market reaction. The reason lies in the economic significance of the waterway. The Strait of Hormuz is a critical transit route for global energy markets, carrying a substantial proportion of the world's seaborne oil supply. Any threat to its stability raises the prospect of higher crude oil prices, increased inflationary pressure, and a stronger U.S. dollar. Because crude oil is predominantly traded in U.S. dollars, rising oil prices often increase demand for the dollar. A stronger dollar generally creates headwinds for gold because gold is priced in U.S. currency and becomes more expensive for holders of other currencies. This inverse relationship between the dollar and gold limited the precious metal's ability to benefit fully from geopolitical uncertainty. At the start of the week, gold prices remained under pressure as markets focused on currency movements and interest rate expectations, rather than purely seeking protection from geopolitical risk. The prospect of higher inflation caused by energy prices complicated expectations about the Federal Reserve's future policy path. While inflationary concerns can sometimes support gold as an inflation hedge, they can also delay interest rate cuts, which increases the opportunity cost of holding a non-yielding asset such as gold. During the middle of the week, gold found some support as investors reassessed the balance between economic risks and monetary policy. Any weakening in U.S. Treasury yields or expectations of eventual Federal Reserve easing provided some relief. Lower interest rates generally benefit gold because they reduce the relative attractiveness of interest-bearing assets such as government bonds. However, gains remained limited because the U.S. dollar continued to act as a major market driver. Gold's traditional safe haven role was partially offset by the dollar's strength, demonstrating that not all geopolitical crises produce an immediate gold rally. The market reaction depended on which force was dominant: fear-driven demand for protection or currency and interest rate pressures. By Friday, 17th of July, gold closed the week with investors still closely monitoring three major themes: the trajectory of Federal Reserve policy, movements in U.S. bond yields, and developments in the Middle East. The market remained sensitive to any evidence that inflation could remain elevated, as this could influence the timing and scale of future rate adjustments. The week highlighted an important principle in gold investing: geopolitical tension alone does not guarantee higher prices. Gold performs best when uncertainty combines with falling real interest rates, a weaker U.S. dollar, or declining confidence in financial assets. In contrast, geopolitical shocks that strengthen the dollar or push interest rates higher can temporarily weigh on gold despite increased global anxiety. Looking ahead, the gold market is likely to remain highly responsive to Federal Reserve communications, inflation data, employment figures, U.S. dollar movements, and any escalation or de-escalation in Middle East tensions. The Strait of Hormuz remains a significant geopolitical risk factor, but its impact on gold will depend on whether markets interpret the crisis primarily as a threat to global stability or as a catalyst for higher inflation, stronger energy prices, and dollar appreciation. In summary, gold's performance during the week of 13 to 17 July 2026 demonstrated the complexity of modern financial markets. Safe haven demand competed against currency and monetary policy forces, with the U.S. dollar and Federal Reserve expectations ultimately playing a central role in determining price direction.